when January's positive, the full year is positive 86.5% of the time. When it's down, it's only up 44% of the time. So down Januaries are an issue, and it's not necessarily a standalone indicator. It's not a standalone indicator. I never claimed it to be. You use it
Hmm.
in conjunction with your other data, your other indicators, and you take it, to confirm or reassess your outlook on the market. And it's a time to check. I mean, our base case scenario for about 8 to 15%, depending upon Dow or S&P, Nasdaq, is still in play for election year 2024. And you want to talk about the other history. Is this is an election with a sitting president running for reelection.
Hmm.
I've told you before that percentage is 12.8% when there's a sitting president running versus minus 1.5% for S&P when it's an open field. So
Hmm.
everyone that's hoping that we have a different race or a different election battle, maybe they're short the market or something right now. I don't know, but it would probably create some uncertainty and go down there. So we had the selling in the beginning of January.
Yep.
January has become a little bit of a profit taking period. We were up quite exponentially or parabolically at the end of the year, right on cue with the pre-election year seasonal pattern, making the high at year end or almost year end within a couple of days. But now, I've got a chart. I think Arush has probably seen it and I can send you the updated one to lay in there, where 2024 is back up into the sitting president election year seasonal pattern, tracking that. And then, first 5 months are important, does better when the sitting president incumbent party wins, and you can reverse handicap that, so that if the market doesn't do well in the first 5 months, it means the incumbent might get ousted, which means the market won't be as strong. Except the last 7 months of election years, only two down periods since 1950. You could guess them: 2000 with the undecided election and '08 with the great financial crisis.
Yeah,
So there's a
and so Jeff, I've shared this S&P 500 election year seasonal pattern. It should show up here in a second. Uh, and before we get a little bit further into the current year, Jeff, I just want to take a moment and go back to last year when you were on, when we went over the trifecta,
Yeah.
when everyone was 100% convinced that we were going to have a recession, and yeah, I was concerned too, everything, and the almanac, the seasonality, everything worked perfectly. I talk a
yeah
little bit about that because it was well done. The calls, you absolutely nailed the calls on your
Thank you.
webinars and through your blog. So I want to make sure everyone hears that and how important how
Yeah,
well it worked last year.
I mean, we hit the trifecta last year. All three were positive, which was the opposite of 2022 when we didn't get them all. And we were also in a midterm year.
Hmm.
After a big 21, we had our midterm bottom. Remember, we called that
Yeah.
October 22 low as well.
Yep.
And so that set up the 2023 pre-election year pattern. We had Yale's line was, midterm years are a bottom picker's paradise. We had the October bottom in a midterm year. I mean, it's like tee it up for me. This cycle, has been a textbook. Um, so I'll tell you that it's not always this way. It's not always going to be this way. But right now, this whole 4 year cycle going to 24 it is still tracking. And as I mentioned, we hit that sweet spot of the 4 year cycle, the Q4 midterm year to Q2 of the pre-election year. We had that weakness that we tracked and we're all over last year. Another October bottom, a late October bottom or low or whatever you want to call it, and then that Q4 high. So here we are entering with the 4 year cycle continuing to track, including that chart that you're showing there with the different election year patterns. And unless something changes, I mean, Matt, everyone's looking for this recession. I don't know what's going on with the leading economic indicators and the yield curve inversions. Now that it's going to revert, it's going to go. The market's going to sell off. Everyone's worried about sentiment right now. I mean, I looked at the investors' intelligence. I know you look at other sentiment indicators. If you go back to 21, not so long ago, we were up at these bullish extremes for the whole year, and the market just plowed right through it.
Yeah.
So, bullish sentiment, if it's not at serious extremes, can stay that way and continue to be bullish. And with the sentiment indicators, just to shoot off on the side of that, they really only work great at lows when there's a whole bunch of bears and not a lot of bulls. They're not really great at calling tops. They're much better put call, whatever, AAII, whatever you want to use. It's better at the bottom. So here we are, new all-time highs. Yeah, the breath has something, leaves something to be desired. That can catch up. The small caps are wavering a little bit. Nasdaq's not quite hitting a new high, but Papa Dow and the S&P, are leading. Maybe we'll get some more rotation, but also if you look at this chart that we still have up there, thank you for keeping that there. February is the weak, excuse me, the weak link in the best 6 months.
Yeah.
And we also see some Ides of March low periods. You can sort of zoom in on that there, which is typical of a lot of years, but also election years here. So we had a good January. We had a great fourth quarter. I wouldn't be surprised if we get a little backing and filling here through February and into March. Probably give people a good opportunity to adjust portfolios and do some more buying. So that's kind of the background of history. And the Fed today also saying we're not cutting so fast.
So potentially a pullback over the next couple of months that would give enough time for a lot of these tech stocks that have shot out and have done really well over the last few months to set up bases. And then really it's more where we have where the markets work a lot better after the election, right?
Yeah, I mean, we're expecting some weakness in Q2, Q3 as well, the typical worst 6 months period. But, the end of election years, again, you can see it right there in the chart. You got after the election, September, November, December, bullish. It's next year's another story. Well, I don't want to spoil the party, but we might get some return to some bearishness in the next 2 years, 25, 26. But for now, the bulls are are in charge,